Hello friends, in this video I'm going to walk you through Benjamin Graham's famous phrase about a voting machine and the weighing machine. Now, if you're new to the channel, my name is Charlie and I'm an investor based here in the UK, and on Kowalah School we're helping young and first-time investors to start their investing journey safely and successfully. Now in this video, I'm going to dive into a famous phrase by Benjamin Graham, one of the most famous investors. And his phrase is that in the short term, the stock market is like a voting machine. And in the long term, the stock market is like a weighing machine. Now, when I first started investing, I read this book, The Intelligent Investor. And Benjamin Graham wrote this in the late 1940s, and it's considered one of the most influential investing books. In fact, it's still on the best-selling lists today. Warren Buffett, who's one of the most successful investors alive today, counts Benjamin Graham and this book as one of his most important influences. Now, it's a long book, 600 plus pages, and it's quite heavy going. But there is this one phrase that really stood out to me when I was reading it. In the short term, the stock market is like a voting machine, and in the long term, the stock market is like a weighing machine. Now let's dig into that in a bit more detail. So in the short term, the stock market is like a voting machine. Whenever you buy a share, you are buying it from someone else who is selling it to you. Someone else needs to want to sell it at that price for you to buy it. And conversely, when you want to sell a share, you need to find someone else that is prepared to buy it from you at that price. A good way of thinking about this might be your friend has got a really nice jacket that they bought for £50 and you might really want that. Can I have your jacket? And you offer them £10. Well, of course, they're not going to sell it to you because they're going to lose money. But you might offer incrementally more and more and more money until you get to a point whereby they cannot say no. That might be £60. Well, I'm going to offer you £60 for a jacket that cost them £50. Okay. And it's exactly the same with shares. If there's a particular company or stock that everyone wants to buy at that moment, then the price is going to go up and up and up until someone that owns one of those shares is prepared to sell it. Now, a few weeks ago, you might have heard about a company called GameStop, a pretty ordinary organization. They're one of the biggest video game retailers in the United States. So they've got retail outlets and stores in shopping malls, shopping centers, and high streets. Now, a few weeks ago, for reasons that I won't go into in this video, a lot of people started buying GameStop shares. And this meant that the price of those shares went up a lot. In early January, GameStop shares were trading at just $18, but by the 25th of January, this had gone up to $76. Now, this put it on the radar of a lot of young and first-time investors. On TikTok, on YouTube, on Twitter, all of the chat was around GME, GameStop. This stock is only going one way. You've got to get in. It's going up. It's a quick way to make loads of money. Hashtag YOLO. You only live once. Exciting stuff. But the reason that the share price was going up was because everyone else wanted to buy those shares. As more and more people wanted to buy GameStop shares, the price went up and up to encourage other people in order to sell those shares. And by the 27th of January, just a few days later, the price had rocketed to $347. Imagine if you had bought a GameStop share at $18 and had then been able to sell it at $347. Well, that all sounds very exciting. But at that peak of $347, suddenly more people started selling than wanted to buy these shares. And suddenly the reverse happens. Suddenly, people can't get rid of their shares as quickly as they might want to, and the price starts plummeting. And with only a few days, that $347 peak was a distant memory, and many people had lost a lot of money, especially those people that had bought those shares at $347 at the peak. By the 18th of February, GameStop shares were trading back at $40, and many individual retail investors were nursing big losses. either real cash losses or they're keeping hold of their GameStop shares and hoping for a resurgence. And we're certainly seeing that over the last couple of weeks. Now, this is an example of the voting machine in action. GameStop as a company had not changed over the course of those 2 weeks. They hadn't launched any new products. They hadn't opened up in any new territories. They'd not acquired any big competitors. GameStop as a business was just trading as normal. But the voting machine was in action and had seen this massive increase in shares purely because of what everyone else was trying to do. Now let's take a look at the second part of Benjamin Graham's phrase, that in the long term, the stock market is a weighing machine. Now, what he means here is that when you start to look at a 10 or 20-year time period, actually, it doesn't matter about individual investors like you or me piling in or trying to get out. Ultimately, the success of a stock price will depend on the success of the company itself. If we take a look at Amazon, Amazon's coming up to its 25th birthday shortly, and they have been public since 1997. But if we look at the early years of Amazon's stock price, it was not in favor of many investors. People were worried, are they going to be able to make a profit? Are we going to be able to see a return from the money that we invest in this company? But as Amazon has continued to build out the logistics, grow around the world, release great new services and become, for many, the default online retailer, we see in the last 5 or 6 years this dramatic increase in their share price. So if you had been an original investor and have managed to stay the course and continue, then as Amazon has become a cash generating machine and seen massive profits, you can see that is proven in the share price. And this is what Benjamin Graham means about the weighing machine. Ultimately, if a company makes a lot of profits, if they pay out dividends, if they grow your investment, then the stock price is going to increase. Conversely, if a company doesn't make a lot of money and it does not pay out any dividends, then the share price is going to fall. So over the long term, it's a weighing machine. As long as the company makes money, you will see returns. So why is this phrase so important if you are a young or first-time investor? Well, it's so important for you to distinguish between long-term investing, which is investing in companies that are going to make a profit, the weighing machine, versus speculating and gambling on what other investors are going to do, which is the voting machine. You can't try and beat the voting machine. You don't know when $347 is going to be the top for GameStop. There were plenty of people that thought that was going to go much higher, and that's why they lost their money. If you play with the voting machine, you really do risk being that person that bought GameStop shares at $347 and lost all their money. The easiest way to invest in the weighing machine is to invest in low-cost index funds that will help you to be invested in all of the greatest companies across the United States. So remember, in the short term, the stock market is a voting machine. And in the long term, the stock market is a weighing machine. I hope this has been a useful video for you. If so, please share with your friends and click to subscribe to the channel because we've got loads of great new content coming over the next couple of weeks. I'll see you there.